PayPal has fallen hard, but instead of being biased against the stock price, we're going to look and see if it's a value play right now. Guys, if you're new to the channel, I'm Paul. My job is to teach because the more you learn, the less you will fear. And I also call out these financial fraudsters all over the world. Come check out our channel. So we're doing this video on PayPal. Now, guys, what we're trying to do, I want to show some excitement in the channel. We love the comments that are given. So please drop a comment in here. We love it. So one of the things we like to do is a lot of hate in the past. So we want to pull up kind of like a mean tweets kind of thing, pull up some of the comments from the previous PayPal. So first comment, Cam said, dude, based on your analysis, you won't buy any freaking stock. You guys are a joke. Okay. Next comment. Do you have Venmo? No. Then sign up. Who is that arrogant to impose on others on how to get paid for what the hell does that even mean? Final one. Vitali. You guys must only have super growth companies like Intel and IBM in your portfolios. Everything else is overpriced. Okay. So they weren't so bad. But guys, we read all the comments, good and bad. Sometimes I go in, was on board, I just respond to people. You'll see my PG. But either way, if you like this video, we're going to do a full 8-pillar process on PayPal. This has become our signature. We're going to use our software here. If you like the software, go to everythingmoney.com to sign up. So let's go look up PayPal. So let's go to the, all right, guys, look at the stock. Look at the price for PayPal. So look at this big run up and then collapse. It had a high of 310 in the last 1 year and a low of 70. And it's currently at 71.63. So basically there. It was very close to its 52-week low. So pillar number one, we want the 5-year PE for PayPal to be under 22.5. So on this main page on the left side, 5-year PE 28.3. So that's an X. Now, don't sit there and make your judgment based on that. Because remember, PE should be a reflection of moat and growth potential. So if this company is going to grow like crazy, you should be willing to pay a higher PE. Pillar number two, we want the 5-year return on invested capital to be greater than 9%. Again, main page, 5-year return on invested capital, 12.8%. So they do a good job of reinvesting the money that is made in the business through debt and equity. Pillar number three, very simple. We want revenue growth over the last 5 years. So we scroll to our income statement and the very top line, 5 years ago, 13.8 billion, last year, 25 billion, almost double, check mark there. Pillar number four, we want the net income for the company to also have some growth. We scroll down to the net income line, 1.92 billion to 3.58, check mark there. All right, so we're getting some traction here. Pillar number five. Now this one, guys, is very important. I call it the silent killer for stocks. We want to see if the shares outstanding are increasing or decreasing. When a company issues shares, they are diluting the other owners of the business. So if a company had 10 shares and you own one, you own 10% of the business. If they suddenly issue 2 more shares to generate capital, you now own 1 share still, but have 12 shares. So now you only own 8.33% of the business. You have been diluted. All right. So to find out if we've been diluted or not, we scroll all the way to the bottom the income statement. We go back to this right here, 1.2 billion. We actually go to the end of the 6th year and go to the most recent 1.16, check mark there. So they are not diluting their owners. Now, buying back shares of an expensive company isn't a good thing, but we'll get into that in other videos. Pillar number 6 has to do with debt. So guys, debt works on a company just like it works with you as a person. The more debt you have, the more likely you'll have financial problems if things get tight or worrisome recession. So how do we figure out if a company has reasonable debt? Well, we start with this one pillar. What we do is we go back to our main page and we look at the 5-year average free cash flow, 4.15 billion. We multiply that by 5. That equals $20.75 billion. We want the long-term liabilities to be under $20.75 billion. So where do we find that? Very simply, on our software, we go to the balance sheet and we scroll all the way to the bottom. Long-term liabilities right here, 11.24. So almost half of what's needed. Another great stat. Pillars 7 and 8 have to do with free cash flow. So what is free cash flow? Free cash flow is cash from operations less your capital expenditures. And there are 5 things you can do with free cash flow. Buy back shares, pay down debt, pay dividends, reinvest in yourself, or make acquisitions. You can do any combination of those 5, none of them, all of them, doesn't matter. So we go to the cash flow statement in our software. We scroll a little bit down and look what I did, guys. Because your Uncle Paul loves you, we added this line to the cash flow statement to do the math for you. 5 years ago, 735 million. Last year, 5 billion. That's a check mark. And then finally, just like PE, we want to come up with some sort of value for the company based on a multiple of free cash flow. So we take for the 8th pillar, their 5-year average free cash flow of 4.15 and multiply by $22.5 billion. And we get 88 and call it $90 billion. $90 billion. So we want the market cap to be under 90 billion. So let's go back to our main page. And guys, good news. This is all done for you in our other pillar, but the market cap is 83.79. So check mark there. It is below the $90 billion mark. So again, if you don't want to do all that math and you have our software and you've been following along, go to the 8 pillars tab and look, the only one we have an X on is PE. So you have to figure out why are the PE and the free cash flow numbers so different. That's the one thing to find out. Once you find that out, you'll be able to do a lot more information. So with all these check marks, you're probably thinking, wait, do I buy this company? Slow down. And I apologize, but I'm trying to teach you how to buy a piece of a business because that's what you're doing when you buy a stock. But what we can do is we can sit there and make assumptions about the future because we don't know the future, but every investment you're buying a future stream of cash flow. So we created the stock analyzer tool, by far the most popular thing on our site. So you go to the stock analyzer tool. All right, so the stock analyzer tool, we're going to sit here and put assumptions in. The first one I'm doing is a 10-year of analysis. Now I put in the 1, 5, and 10-year numbers for revenue growth, profit margin, and free cash flow margin. These should be guiding points for your inputs. My job is to be conservative and buy companies out of the 10,000 companies out there, the 20 or 40 that using conservative estimates still make a lot of sense. So we look at the 1, 5, and 10-year numbers. There are no 10-year numbers here, but in the 1 and 5-year numbers, 12.9 and 16.9%. So it's slowed down a little bit. I'm going to go even more conservative. I'm going to go 4, 7, and 10%. Profit margin, 13.9 last year, 15.3 over the last 5 years. So I'm going to go 12, 14, and 16. Free cash flow margin, I'm going to do 16, 18, and 20. PE. Now, guys, remember, PE is a reflection of growth potential and moat. I do think there's a good moat there. Is it a huge? I'm not a big fan of using the moat argument for buying stocks, but people who want to trust somebody buy through PayPal. That's a very common thing. I do it. I love it. When I buy something, I try to use PayPal whenever I can. But for PE, remember, we're looking at the PE 10 years from now when they've already grown a ton more. So what PE are you going to assign? I'm going to assign 13, 15, and 17. Same with the price of free cash flow. And finally, my desired annual return, 12.5%. And the reason being is you can get 9 or 10% from an ETF. So in order to get an ample margin of safety, a reasonable margin of safety, and some reason to buy an individual stock, I hit 12.5%. I hit the analyze button. The stock is currently at 71.73. And here are the numbers. A low price of 33 to 44, high price of 80 to 100, middle price of 52 to 66. Now, these numbers are going to be based on your inputs, and those inputs need to be based on some assessment you've done. If you're all green on your assessments, that doesn't mean go buy. It means go do more research or join our community. When you're doing this, if you already have the software, you have the community, go in there, join the 12,000 people who've already signed up and engage in the conversation about PayPal. You can specifically search about PayPal and go talk to people who've done more research than you and find out what they're saying pro and against PayPal. If you like this video, guys, please like and subscribe to the channel, forward on to somebody else. And if you want to learn more about our full 8-pillar process, click the video above and we explain it in more detail. Thank you very much.